Wall Street's top traders, 2 Nobel Prize winners, and unlimited investor demand. What could go wrong? 1991. John Meriwether just got pushed out of Salomon Brothers. He was one of Wall Street's biggest traders and a pioneer of bond arbitrage trading. JM decided to create something bigger in the form of LTCM. In 1993, he reunited with his fiercely loyal former team, recruiting top traders from Salomon, including Eric Rosenfeld, Larry Hillebrand, and Victor Haghani, who had been waiting for his comeback. What made LTCM unique was its dream team, which included 2 Nobel laureates in economics, Myron Scholes and Robert Merton, renowned for their work on the Black-Scholes option pricing model, alongside experienced Wall Street traders. LTCM primarily employed a strategy known as relative value arbitrage. This involved using complex quantitative models to identify small price discrepancies between highly correlated securities in different markets. Put simply, they found tiny pricing differences in similar bonds. Imagine a bond selling for £100 in one market and a similar one at £100 and 10 pence in another. They'd buy the cheap one and sell the expensive one. Easy 10 pence profit. But here's the thing, 10 pence isn't much, so they borrowed massively. For every £1 they actually had, at one point they had borrowed up to £100. This is called leverage. It turns small profits into huge ones. But what we tend to forget is that it works the other way around too. That is, when you lose, you can stand to lose everything. 100-to-1 leverage. Think of it like buying a £500,000 house with just £5,000 down. You're amplifying your gains, but also your risk. So what is relative value arbitrage? Take, for example, the U.S. government debt. The U.S. government issues new bonds regularly. The newest bonds, called on the run, trade at slightly higher prices than older identical bond called off the run. Why? It's because new bonds are more liquid, so therefore easier to trade. But they're economically identical. LTCM would buy the cheap off-the-run bond at £99 and short the expensive on-the-run bond at £100, betting the £1 spread would narrow. When prices converged, say to £99.50, they'd profit on both sides. The long position gains 50p and the short position gains 50p, totaling £1 per bond pair. A tiny edge on paper, but multiply by millions of bonds and layer on massive leverage, and you've got substantial profits. LTCM's early years were nothing short of spectacular. In its initial years, LTCM generated impressive returns, boasting annualized returns of over 40% in 1995 and 1996. For context, S&P 500's return in 1994 was 1.32%. Their sophisticated models seemed to be delivering consistent profits, defying traditional market volatility. By August 97, they were managing $6.7 billion of capital. Everyone wanted in. They started turning investors away. They were so confident, they returned money to investors because they didn't need it anymore. Wall Street called them geniuses, Nobel Prize winners, running a fund that couldn't lose. The models were perfect. For 4 years, LTCM dominated. They thought their mathematical models had eliminated risk. However, in the words of Al Pacino,
"Don't get too cocky, my boy, no matter how good you are."
LTCM's increasing reliance on leverage to magnify returns, coupled with dangerously high liquidity risk, essentially making the same bet repeatedly that market inefficiencies would narrow as investors arbitraged them away, made it extremely vulnerable to adverse market movements. Long-term was essentially an insurer of financial risk. The fund was getting premiums for the risk of owning less liquid and generally riskier bonds, such as off-the-run treasuries, emerging market debt, mortgage IOs, etc. As Victor Haghani, the youngest partner at LTCM, said after the firm's demise, "The hurricane is not more or less likely to hit because more hurricane insurance has been written." In the financial markets, this is not true. The more people write financial insurance, the more likely it is that a disaster will happen, because the people who know you have sold the insurance can make it happen. A series of market shocks, starting with the Asian financial crisis starting from Thailand in 1997 and then escalating with the Russia defaulting on its debt in August 1998, began to destabilize global markets. LTCM held Russian bonds and lost money immediately. But that wasn't the real problem. The real problem was what happened to every other position they held. Every LTCM strategy bet that spreads between similar assets would narrow. Instead, they widened dramatically. On-the-run bonds soared, off-the-run bonds crashed, volatility spiked, swap spreads blew out. Every position lost money simultaneously. Markets became highly volatile. Investors fled from everything from corporate bonds and emerging markets to complex derivatives. Money flooded into the safest assets, U.S. Treasury bonds. This is called flight to quality. Remember that 100-to-1 leverage? It worked both ways. A 5% loss on their positions meant a 500% loss on their actual capital. Week 1, down 500 million. Week 2, another 800 million pounds. Week 3, 1.2 billion. Their models said this level of market movement was a 1 in 10,000 year event. August 1998 was that year for LTCM. By early September, they'd lost half their capital, 2.3 billion gone. LTCM tried to exit positions, but they were too big. Selling would crash prices further, creating more losses. Making matters worse, LTCM wasn't alone. Many other hedge funds and trading desks held similar convergence trades. As rumors of LTCM's distress spread, these firms rushed to exit their own positions to avoid getting trapped in the same liquidity squeeze. Some traders also engaged in predatory trading, deliberately selling against LTCM's known positions. Whether self-preservation or predation, the effect was the same. A catastrophic unwinding, where everyone's liquidation accelerated everyone else's losses. Every time LTCM sold, competitors drove prices lower. It became a death spiral. By September 21st, they had 600 million left, managing over 100 billion in positions, down from 4.7 billion from the start of the year. A staggering loss of about 87% within 9 months. This led to Warren Buffett's, along with Goldman Sachs and AIG, offering to buy out LTCM's partners for $250 million and inject $3.75 billion in fresh capital. But the deal collapsed when LTCM failed to accept by Buffett's tight 1-hour deadline, reportedly due to legal complications and the partners' reluctance to lose control. This wasn't just LTCM's problem anymore. They had borrowed from nearly every major Wall Street bank. Goldman Sachs, Merrill Lynch, Bear Stearns, JP Morgan. If LTCM went bankrupt, they'd have to liquidate 100 billion pounds in positions immediately. This would crash bond markets, equity markets, derivatives markets. Banks would lose billions. The Federal Reserve called an emergency meeting. This was systemic risk, one fund threatening the entire financial system. New York Fed president arranged for a consortium of banks to rescue the financial system from collapse. Collectively, they injected $3.625 billion in the fund and effectively taking control. Bear Stearns held out as it felt it already had substantial exposure as LTCM's clearing agent. Ultimately, LTCM was liquidated, and its assets were unwound over several months. Merriweather went on to start another fund in 1999, named JWM Partners, with some of his loyal traders, including Victor Haghani and Larry Hillebrand. JWM failed and was shut down in the wake of 2008 Great Financial Crisis. The lessons from LTCM remain relevant today. First, leverage can kill. As Buffett said in the wake of the fund's collapse on leverage, but to make money they didn't have and didn't need, they risked what they did have and did need. That is foolish. That is just plain foolish. It doesn't make any difference what your IQ is. Second, mathematical models fail during crises. They're built on historical data that doesn't properly take account of extreme events. Third, diversification can't protect you when everything moves together. Finally, systemic risk is real. LTCM wasn't just too big to fail. It was too interconnected to fail. And 10 years later, we'd see these same lessons ignored in the Great Financial Crisis of 2008. So what was the ultimate lesson for those who lived through the collapse? Take Victor Haghani. He was one of the core partners at LTCM, a man who spent years building complex models to chase maximum returns. But after the dust settled, he didn't double down on leverage. He walked away from it. Haghani realized that for his own wealth, the stress of chasing alpha wasn't worth the risk of ruin. He founded Elm Wealth in 2011 with a new philosophy: simplicity. Today, he manages funds using low-cost index investing, famously stating he just wanted to quote, reduce tail risk and avoid the trap of leverage. If one of the smartest quantitative minds decided that the best way to build wealth is to stop trying to outsmart the market and just buy the index, maybe we should too.